So guys, today we're looking at 3 dividend stocks that are almost perfect. And when I say almost perfect, this isn't just my opinion. This is based on the Snapscore, which is the proprietary scoring system we built into Snapstock to measure the quality of a company. As you can see, the Snapscore grades businesses across 5 key areas. We have growth, profitability, debt, dividends and buybacks, and capital efficiency. And obviously, the higher the score, the better the company. And the 3 stocks we're talking about in this video have the highest overall Snap scores I could possibly find. As we'll see, they're pretty much flawless across every category. That's why I call them almost perfect. And as we're going through these 3 stocks, let me know in the comments below if you own any of these. I'd love to hear about it. So I know a lot of you guys out there own ASML. This is a Dutch company that plays an incredibly important role in the semiconductor industry. They design and manufacture photolithography machines, which are the giant, complex pieces of equipment used by chip makers like TSMC, Intel, and Samsung to produce semiconductors. Now the thing is, ASML is the only company in the world that is capable of producing these extreme ultraviolet lithography systems, or EUV systems as they're called, which are essential for making the chips that power everything from your smartphone to data centers to the computer in your car. With that said, what makes ASML so special is this monopoly-like position. Because no other company can produce these EUV machines, ASML is irreplaceable in the eyes of the world's biggest chip makers. Plus, their technology is so advanced and so expensive. I mean, each EUV machine can cost over $200 million, so that creates massive barriers to entry for any potential competitor. And given the global demand for more powerful semiconductors in everything from AI to even your refrigerator, ASML sits right at the center of what many consider to be one of the most critical industries of the future. And with demand for AI only continuing to explode, it's not just companies like ASML that are powering the future. AI is rapidly changing the way that regular people like you and me can build things online, and that's why I'm so excited to tell you about Hostinger Horizons, which is the sponsor of today's video. One of the biggest shortcuts to reaching financial freedom is having more than one income stream. The more that you have, the sooner you can get there. And with Hostinger Horizons, creating an entirely new stream of income online has never been easier, even if you're not very tech savvy and have never built a website before. Hostinger Horizons is an AI-powered, no-code platform that lets you launch a website just by chatting with AI. All you have to do is tell it your idea, which you can do in over 80 different languages, and within minutes, it builds out a fully functional website that's mobile-friendly and optimized for SEO. Now, as an example, we'll go through a little demonstration. Let's say you wanted to whip up a dividend portfolio tracker. Using Hostinger Horizons, you would just need to type in a prompt like this one right here. And then once you have your prompt ready to go, all you need to do is click that and it'll start thinking up a website for you. Here we can see it getting to work. It's going to take a second to think, but all in all, it shouldn't take more than a minute or so. Awesome. So this is what it came up with. Very clean looking layout. Let's add a stock to see how it works. Maybe we'll put in some Snap on right here. Maybe we've got 5 shares. We'll say our average cost is about $2.20 per share. I think the current share price is $3.22 as I'm recording this. They pay out $8.56 in dividends, and they are in the industrials sector. Awesome. So once we add that, we can see that the spreadsheet here starts to fill out, and it's looking pretty good. Now, obviously from here, you can continue to make changes and continue tweaking and fine-tuning things until it is to your liking. But then once you're ready to go, all you need to do is go up here to the top right and click publish, just one click, and it'll make the site live. And the cool thing about doing all this through Hostinger is they will take care of all of the back-end stuff for you. So they'll host the website, you can add your own custom domain, and you can set up your own custom email all right here within the platform. Plus, with integrations like Stripe, PayPal, or even Google AdSense, you can start charging subscriptions, accepting payments, or monetizing with ads right out of the gate. If you've been sitting on an idea, guys, now is the time to launch it. Just head over to hostinger.com/Ryne or click the link in the description of the video and in the pinned comment and use the code Ryne at checkout to get an extra 10% off your subscription. Remember, every new income stream gets you one step closer to reaching financial freedom, and this one is incredibly easy to set up. So click the link in the description of the video or in the pinned comment and use Hostinger Horizons to bring your idea to life today. Anyway, guys, getting back to it, ASML, like I said, has one of the highest Snap scores that I have ever seen. Overall, their scores coming in at 9.47, which is almost as close to perfect as you can get, and from top to bottom, they are scoring really high. They have a perfect growth score, profitability is 8.8, and that's really solid. Debt's perfect, dividends and buybacks are perfect, and capital efficiency coming in at 8.25 is still incredibly high. So from top to bottom, we're looking at an extremely high quality company, and looking at the share price performance, it's seen a nice pop in the last month. The stock is up about 9%, and if we zoom out looking at the year-to-date performance, it's up a little bit more. So far in 2025, ASML is up about 12%. With that said, based on some of the relative valuation metrics, it looks like ASML could potentially even be discounted compared to its historical averages. Looking here at the PE ratio, this is coming in at about 32.5, which is a pretty high PE ratio, but ASML is a very growthy company, as we'll see. I mean, they do have a perfect growth score after all, so it's no surprise to see the PE ratio this high. And this is also about 18, almost 19% below the company's 5-year average. So based on its average PE ratio, it's looking to be more attractively valued. Same thing here with the free cash flow yield. This isn't going to be the highest free cash flow yield, only at 3%, but this is 8.4% above the company's 5-year average free cash flow yield. So that's definitely something. Now, scrolling down, looking at the growth metrics, it's no surprise that they get a perfect score. The revenue's grown by almost 20% on average over the last 5 years. Earnings per share has grown by almost 23% over the last 5 years, and free cash flow is coming in close to 30% on average over the last 5 years. And everything here is straight up and to the right, as we can see. This is exactly what you'd want out of your investments. So when it comes to things like the PE ratio being above 30 or the free cash flow yield not being as high as maybe some other companies out there, I think it makes sense when you look at these growth numbers here. This is clearly a very growthy company, a very high quality company, so you would be paying up for that. Now, adding to what was a perfect growth profile, I think the debt situation is looking the same. They have more cash on their balance sheet than they do debt, which I think is pretty impressive for a company that manufactures such heavy equipment, heavy machinery. And I say this all the time, but a company with negative net debt or a net cash position is one of my favorite things to see in an investment. It just adds to the resilience of the company, and debt's just one less thing that you have to worry about. Now, getting into the dividend stats, the yield here is not going to be high at all. It's less than 1%, which I think is pretty typical for a company like this. Typically, these very growthy companies are not coming with the highest yields, but they are coming with high dividend growth rates, and that's exactly what we're seeing here with ASML. The 5-year growth rate's about 24%. The 10-year is actually a bit higher at 26.5%, which I think more than makes up for the low starting yield. And if we scroll down looking at the payout ratios, no surprise, the dividend is very well covered. In the trailing 12 months, the earnings payout ratio is less than 30%, and the same is true here with the free cash flow payout ratio. Actually, these two are pretty neck and neck. Looks like the free cash flow payout ratio is even a little bit higher. So all in all, not only does ASML look perfect across the board, but the valuation's really not too bad right now either, which I think is rare to see for a company that is so high quality. So with that said, I definitely think ASML is one to keep on your radar. So Visa definitely doesn't need an introduction. Every time you swipe or tap your card or make an online purchase, there's a good chance Visa is powering that transaction. And the thing that often gets mistaken about Visa is they don't actually issue the credit for their credit cards. Your bank or wherever you get your credit card from is on the hook for that. Visa just runs the massive payment network that connects all the merchants and the banks and the consumers. They're actually the world's largest payment network. And last year alone, Visa processed almost 234 billion transactions with a total payment volume of almost $16 trillion. Now, what makes Visa stand out is the size and strength of its network. They actually refer to themselves as a network of networks. And with more than 4 billion cards in circulation, Visa benefits from one of the most powerful network effects in the world. Basically, how it works is the more merchants that accept Visa, so the more stores or restaurants or online shops or anywhere else that you can spend money, the more of those that accept Visa, the more valuable it becomes to consumers, and vice versa. On top of that, as payments continue to shift even more into the digital realm, whether that's online shopping or mobile wallets or any other way of digitally moving money, Visa is making it a point to be at the forefront of that, so their network effect will likely continue to expand. Now, like ASML, Visa's Snapscore is going to be above 9, although it's not nearly as high as ASML's. It's only 9.3, but still, this is nothing to stick your nose up at. This is undeniably a very high quality company with some great scores. growth is 9.4, profitability is a perfect 10 out of 10, debt's 8.7, dividends and buybacks perfect 10 out of 10, and capital efficiency 8.65. So really solid once again from top to bottom. And as far as the share price performance goes, in the last month, Visa's up about 2%, so a little pop there. And if we look at the year-to-date performance, it's been pretty decent. They're up 9.5%, and even over the last year, Visa's been pretty great. It's up almost 21% here. Now, with that said, looking at the PE ratio and free cash flow yield, these do look to be a bit unfavorable compared to the 5-year averages. We're actually getting a lower PE ratio than what we saw with ASML at 29.6, but still right around 30. This is 4.6% above the 5-year average PE ratio, so maybe it's about fairly valued based on this. But with that said, the free cash flow yield is a bit lower than the 5-year average. It's coming in at 3.6%, which is a bit higher than what we saw with ASML actually, but this is 14% below the company's 5-year average, so not the best. Still, scrolling down to the growth section, I don't think it gets more picture perfect than this. This is pure class right here, a real work of art. Revenue has grown by 13% on average over the last 5 years. It is straight up and to the right. Earnings per share has grown by about 19% on average over the same time period. Same thing, straight up and to the right. And the free cash flow per share has grown an incredible amount, about 26.25%. And once again, straight up and to the right. Love to see that. Now, as far as the debt situation goes, unfortunately, Visa does not have a net cash position. They do have some net debt here on the balance sheet to the tune of about $9 billion. But this company is actually generating more free cash flow per year than they have in net debt on the balance sheet. So the net debt to free cash flow is only 0.4. So in less than half a year, if they dedicated all of their free cash flow to paying off the net debt, they could wipe it out. It's no big deal. Now, as far as the dividend stats go, with Visa, we're getting an even lower starting yield than what we saw with ASML. It's coming in at 0.6%, which is a bit below the 5-year average yield of 0.85%. So definitely something to take note of. And the dividend growth rate is still really solid, 15% on average over the last 5 years. It's even higher over the last 10 years. And if we scroll down, no surprise, the dividend is going to be very well covered. The earnings payout ratio in the trailing 12 months is only about 20.4%, and the free cash flow payout ratio is even lower. It's actually just below 20%. Overall, I absolutely love this company. This is actually one of the largest positions in my portfolio, and I would love the opportunity to buy more shares of Visa, but I would rather do it at a lower price, to be honest. Looking at my position, I have 23.74 shares at an average cost of just below $270 per share. So with the share price just above 340 bucks, that's going to leave me up 27.4%, and including dividends, that's going to leave me up about 29%, or just under 29%. So the dividends give me a little boost. As I'm sure you can imagine, it's hard for me to want to buy shares of Visa right now when it's already, a decent amount above my cost basis. But then again, Visa is an incredibly high quality company, and it's only getting better with time, so it could be worth paying up for. Evolution is a Swedish company that has dominated the world of live online casino gaming. Think live blackjack, roulette, baccarat, and even game show type experiences like Monopoly Live. Instead of running the casinos themselves, Evolution licenses its software and its games to some of the world's largest casino operators, and one of their biggest advantages was that they were so early to this trend of live casino gaming. The company was able to massively scale across Europe, here in North America, and in Asia, and today Evolution runs thousands of live gaming tables streamed in real time, which would be really difficult for competitors to replicate. Another strength is their B2B business model. I mean, like I said, they license out their stuff to other casino operators, which helps to create a more steady and predictable revenue stream while also reducing risk and volatility than operating a normal casino. And out of the 3 companies that we've looked at today, Evolution has the highest Snap score at 9.58. Pretty ridiculous, and look at these scores, guys. Growth is perfect. Profitability is perfect. Debt is perfect. Dividends and buybacks almost perfect at 9.4. Capital efficiency 8.5. Still very solid. And looking at the share price performance, they've actually seen a little bit of a pullback in the last month. The stock is down almost 7%. But if we look at the year-to-date performance, they're still up about 13.6%. And I will say, the valuation metrics here look pretty good. The PE ratio is really low. It's only 14.5, and this is also 52% below the company's 5-year average. With that, the free cash flow yield is coming in very high at 6.4, which is 57% above the 5-year average. So it's looking still pretty attractively valued based on these. And my goodness, guys, look at these growth charts. Pretty ridiculous growth from top to bottom. Revenue, earnings per share, and free cash flow per share are all growing by almost 40% every year over the last 5 years. And it looks like it's been even more aggressive over the last 10-year period. This is like a unicorn that we're looking at right here. And then in the debt department, yeah, this is spot on. I mean, they have a net cash position, negative net debt. You already know that we love to see that. So this company's definitely not at risk of going bankrupt anytime soon. And if we scroll down looking at the dividend stats, even these look really incredible. I mean, the starting yield as opposed to the other two companies is way higher, coming in at 3.4%. And just look at this dividend growth. Holy cow. 57% on average over the last 5 years. That is ridiculous. And if we scroll down, it says the earnings payout ratios and the free cash flow payout ratios in the trailing 12 months are really high. But looking at the most recent year in 2024, it's coming in at about 45% and 52% respectively. So with that said, Evolution is definitely another great choice. And with that, if you want to see some more great dividend stocks to buy right now, then check out this next video right over here where I'm telling you about 3 of them that are all deeply discounted and look like great buys right now in September. So click right over here to check those out, and I'll see you in the next one.